All right, so great video for you today. It's kind of a two-part video. So it's gonna be a little bit longer, but stay with me. Some really, really key information in here. So first off, just wanna say happy birthday to all the September babies out there. September birthdays, happy birthday. Best month is here, no doubt about it. Okay, great, let's get started. All right, so the R word. The R word, what is the R word? Recession, right? Recession appears to be upon us, and it's starting to hit Main Street a little bit more because you're hearing more people bring up the R word. What the heck is a recession? Like, we've heard it before, the Great Recession, all that, but what's the definition? All right, so the definition of a recession is when the gross domestic product, the GDP, which measures commerce in a country, right? So for the United States, it's measuring what we produce, our exports minus our imports, and the velocity of money. And velocity, as an example, let's say I'm a barber and I cut your hair, I charge you 20 bucks. You give me $20. I take that, as the barber, I take that same $20 and I go in the mall and I buy a shirt, okay? The person who owns the store, the shirt store, takes that money and goes buys a hat. So that money is changing hands 3 times, right? And that all gets factored into the GDP. So anyway, the GDP, and I think we grow, the United States grows about 2 or 3% a year, and that's kind of the normal rate for an established economy. But anyway, the GDP, the definition, or excuse me, the recession, the definition of recession is when the GDP is consecutive for 2 or more quarters. And it's always after the fact. So technically, we could be in a recession right now and don't even know it until the government comes out and say, hey, by the way, that the spring and summer of 2019, oh yeah, by the way, we was in a recession. And, someone on the street lost their job. Like, yeah, I know that. I lost my job. My neighbor can't get a job. We been knew we was in a recession. What are you talking about? Why are you coming out so late with it? So anyway, it's kind of irrelevant information because it doesn't give you live, you're not looking at, again, unless you're a person that's in the weeds, you're not going to know there's a recession until they come out and report there's a recession. So it's basically a slowdown in the economic growth of a country. Okay, that's a recession. That's the definition of it. Some technical things that are some indicators out there that are leading and pointing to a recession. I'll give you a couple. For me personally speaking, I think optimism has a lot to do with whether or not we go in a certain direction as a country. Right? Think about it like this. You have the entrepreneur who's creating some new product or service in the basement or somewhere, wherever, right? And they're very optimistic people by nature, right? Because for someone to go out and start a business, you have to be optimistic. You got to think my company is going to be better than the next company because X, Y, and Z, right? So you have to put that in there. Otherwise, there's really no point in starting a company. So they're optimistic people by nature. And they hit you with a bunch of projections because it's early days. You really don't know. You're still trying to figure out how the business cycle and accounting and all the other stuff that goes into a business. You're still learning that. So you got a bunch of projections out there. And let's think about it. Let's say we're in the third quarter, okay, and you're an entrepreneur and you're projecting that first quarter of next year, we're going to hit $2 million in sales, okay? So what do we got to do? We got to ramp up inventory to support our projections. We got to go out and hire a sales team to make sure that we're hitting those projections. We need an IT team to possibly handle the traffic on the internet or whatever you're selling, okay? So you're going out hiring people, buying inventory, spending money, helping the GDP because you're optimistic about the future. Now, that can go in reverse, right? You could be pessimistic. You go to the first quarter and you say, I thought I was going to hit $2 million in sales. Man, we in a negative. Our sales are down and we got all this, this inventory that we can't sell and we got all these employees. So what do you start to do? You start to lay people off. You stop buying that inventory. That's going to hurt the person who's selling you the inventory, right? So all that kind of works in reverse, and that could lead to a recession, right? Without even the powers that be that control the purse, without them even influencing the economy, those things can already happen. But then you have something that's a little bit more technical in nature that's indicating a recession, and it's called the inverted yield curve. And it's really simple to get, But of course, the economists and other smart people, they put all this extra stuff in there and try to make it more complicated than it really needs to be. But basically, the short and skinny, we all know that we're in a debt-based economy, right? Our economy works on credit. Everything is credit driven, right? Banks issue credit for, for buying a house, for buying cars, and then there's the credit card company. Of course, there's student loan. Everything is the dollar itself is a debt instrument. It's an IOU. So everything is based on debt, and you got the creditors and then you got your debtors, right? The government is no different. They issue out debt to investors, mainly large countries like China and and others, Russia's and Japan, but also you and me, regular individuals and banks and institutions buy the United States debt. It's also looked as a risk-free investment because the United States is never going to default on their money, right? They're never going to go broke, so they say. So it's risk-free. So all other investments are measured against the Treasury notes. And there's 4 main ones. There's the 2-year, the 5-year, the 10-year, and the 30-year bond, right? And the years just measures the maturity date. So in other words, for an example, a 2-year Treasury note means I give the United States my principal, my capital, my money, okay, to fund the debt, to fund the growth of the country. And in return, they pay me a fixed interest rate. And I got 2 years to wait to get my money back, but I get my interest rate every year, right? It's on an annual basis, okay? So for 2 years, that 2-year note, all that means is I give the government my money, they give me an interest rate for 2 years, every year, and at the end of the maturity date, the 2 years, I get my principal back. So you got a 2-year, you got a 5-year, you also have a 10-year, and the 10-year tracks mortgage rates. So when you go to your local bank and apply for a mortgage rate, that they start with the 10-year, that's the base, right? So if the government is trading, if the 10-year is paying say a 3% return or annual yield, the banks will start with that, and then they'll add on whatever they want to add on, fees and whatever interest rate they want to charge, and that gets you your mortgage. So the 10-year is very important. And then you have your 30-year, which means I'm going to give the government 30 years to hold my capital, and in return, I want, this fixed rate of return or fixed interest rate. And so now, logically thinking and speaking, the maturity years, the longer I hold your bond government, your debt government, the higher I should be rewarded as far as interest payment, right? Just makes sense. If I'm going to give the government my money for 10 years, then I should get a bigger yield than, say, someone who's willing to only give their government 5 years. Give the government 5 years or 2 years. It's kind of like this. You go into the bank, your local bank, they have a CD, right? They have a 6-month CD, and they're going to pay you 1% for you giving the bank your money for 6 months. Then they have a 1-year CD, okay, that pays maybe 2%. And then they have that 5-year CD that may pay 3%. So basically, as a bank or as a government, if I know the number of years that I have your capital for, I can plan my entire business around that, right? I know I got 5 years to go out. I got the first 2 years, I might go out here and gamble. I might go out here and bet on the most riskiest assets around, because I know I got 3 years before I got to give Jason his money back, or Karen her money back, right? I got another 3 years, so I could be a little bit more riskier in the beginning. But when you're only holding the money for a shorter duration, I have to be less risky. Therefore, I don't have the ability to go out here and take chances, gain a better return and then give you the part of that return. So quite naturally, the shorter the duration, the lower the interest rate is going to be. And it's the same way with the Treasury bond. Same thing. If you hold a 2-year, theoretically, you should get a lower return than someone willing to lend the 10-year. Now, with that being said, this is one of the indicators that starts screaming out a recession. It's called the inverted yield curve. Okay, so basically you have your 2-year bond, and I'm gonna make these numbers up right now. Let's say the government is willing to give you 2% for 2 years of your capital. Okay, and then you have the 10-year Treasury bond or note, and the government says, okay, I'm willing to give you 4% for 10 years. Okay, makes sense as an investor. Okay, well, Depending on how long I can, let my capital go out, I might take you up on that offer for 10 years and you give me 4% return a year. Okay, let's roll. Okay. Now, all that's great. Now the economy is doing what it's supposed to do. Everything's great. Okay. When the yield curve starts to invert, first it has to flatten. So you still have this 2-year. Remember, it's at 2% return, and then your 10-year is at the 4% return, right? So when they say that the yield curve is starting to flatten, all they're talking about is that the 10-year that was at 4% is now being lowered to 3%. So it's getting closer to the 2%. So now as an investor, you got to say, okay, well, does it make sense for me to lend the government my money for 10 years and only get a 3% return when I can technically just buy the 2-year and get a 2% return? So as an investor, you got to start to try to make sense of that. Why is the yield going down, and am I willing to give the government my money? Maybe. Okay, so we're still good. Okay. Now the 10-year goes from 3% return a year to now 2.5%. So it's getting closer to the 2 years. So this is what you call flattening, because it's getting closer and closer. Then it eventually flattens. It becomes even. And then the inverted yield curve, when you hear that term, all that means is that the 10-year has now gone below the 2-year. And that screams a recession, right? Historically speaking, when that yield curve inverts, a recession is coming within a year or 2 years or something like that, right? And you got to think as an investor, well, why is the bond market telling me that, the interest rate is only going to be X for the 10-year? And there's all kind of reasons, right? Bonds are thought of as a safe haven asset because the government isn't going to default, so there's no risk there. Yes, you're willing to accept a lower return, right? Like the stock market might yield an 8% return, but look at all the risks that go into that. I got to make sure the companies that I invest in are being legit. They're not out here scamming us, like Enron. So their numbers are accurate. They got to hit their targets. If they tell Wall Street, yeah, in the third quarter we're gonna, sell X amount of iPhones, Apple, then Apple has to hit those numbers. If they don't, then the stock tanks. So there's risk, right? So there's all kind of risk. So the bond market has always, in fact, when the stock market was first created, like the first 15, 20, 30 years of existence, it was always looked as speculation. That's for gamblers, right? The bond market, which was invented many years before that, and in fact, the bond market is actually larger than the stock market. I mean, the stock market gets all the press. CNBC and Bloomberg, they're going to drill those stocks to you because it's sexy, right? Facebook went up, 10% today. In Apple, you're like, all that is sexy talk. But the bond market is actually bigger because not only do you got government debt, you got corporate debt, you got state debt. So it's huge and it's been around for a lot longer. And to the powers that be, it's a much better, safer investment because the governments typically don't default. And if they do default, they're going to restructure their debt and they're still going to, pay it off. Might be at a lower rate, but it's still going to pay that thing off. So there's really no risk there, especially when you're really, really big investor. And there's really, really no risk when you're investing in the bond market. But it's also a safe haven asset. Like I said, when the stock market first got going, that was for speculators. That was for people who were just gambling. I'm gonna throw some dice and hopefully this stock will go up. The railroad stocks will go up. Meanwhile, the bond market, that was your gentlemen. We're astute. We're smart investors. Our smart money goes to the bonds, and we're gonna go, play with the governments and stuff like that. So there's risks there. But yeah. So anyway, there's a recession that's screaming when when the yield curve inverts. Excuse me. So for me, I think optimism is a strong indicator, right? When the economy is humming and people are hiring and all that, then you're going to do well. And then there's also the technical stuff. But again, that optimism can turn around on a dime too. Companies start to plan in the future, preparing for a recession. They got all the data. They know all the numbers. They know all the statistics, what's selling, what's not. What other countries are doing and how their economy is tied to our economy. So when, if they catch a cold, then we'll feel a little bit over here. So they start to prepare, they start to downsize, they'll get rid of jobs and all that to tighten that belt. So those indicators are out there. So a recession is looming. Plus, the powers that be. I always feel that recessions are man-made, right? If they contract credit, and credit is money. If they contract the money supply, then you're going to have a recession because there's no money out there for people to borrow to get their businesses afloat. There's no money for people to borrow to get a mortgage, and all that stuff affects the economy. So when that belt gets tightened and the powers that be, the banks, the Fed, if they start to contract money, if they take money out of the system, everything else falls. When they take that credit out of the system, everything else falls. When they put credit into the system, it inflates. It creates the bubble. But when they drain it out, there goes the economy. So the recession happens. So it's very predictable for them. They can predict when this thing is going to turn. All they got to do is take the credit out. And they know what's going to happen. It might be a little slow at first, but it's going to happen. And it's very, very predictable. Now, for you and I, Main Street, we got to sit there. And the only time we get noticed is when we get that pink slip. Oh, shoot, I lost my job. How am I going to feed my family? I can't do, so for them it's predictable, for us it's not. But there are indicators out there that can lead to you. So the next part of this video is, okay, so we know the indicators are screaming a recession. How can we prepare our wealth and protect our wealth for the oncoming recession? 3 ways, okay? So the first deals with the stock market, right? So most of you are involved in the stock market either indirectly through your 401ks, or if you work for the government, your TSPs, and then the others are involved in the stock market directly because you not only do you have the 401ks and TSPs, but you're also trading and buying stocks on the side, which is great. Okay, cool. All right, so in a recession, typically your high flyers who when the economy is doing well, their stocks outperform drastically the FANG stocks, right? Your Facebook, Amazon, Netflix, and Google's typically outperform drastically. But when a recession comes, they're also the first stocks to get hit and get hit hard. One of the reasons why is because when the economy is doing well, investors are willing to take more risk, and they go and invest in riskier stocks, these high multiple, the high price earning ratio stocks, okay? But when the economy starts to turn, they don't want to take on that risk anymore. Plus, only that, those high flyers produce a lot of profits for them. So they go and start to sell to capture that profit. Why let your stock run up and then let it run down, right? You might as well go ahead and capture that profit. Take your money, sell the stock. And when that selling pressure happens, those stocks get hit, they get hit hard. So if you're in that situation where you got, your stock portfolio is geared towards a lot of these tech and pharmaceuticals and a lot of these, these riskier investments, you're going to want to start to shift to less riskier stocks, or what they call defensive stocks. So prime example, Walmart is a good defensive stock because think about it. When the economy tanks, Walmart does really well, right? Because they're going to get a lot of those customers who were shopping at, say, a Macy's or a Target, maybe a little bit higher end stores. Now they're going to start tightening that belt. Guess where they're going to go? They're going to go to Walmart or your Dollar Trees or whatever, or stores like that. So those stores typically do well in recessions. Plus, not only that, Walmart provides a good dividend yield as well. So those are good stock. That's a good stock to be in. Certain sectors are good to be in. Say like your defense sector, your Lockheed Martins, your General Dynamics, Raytheons. Those companies usually do well in recession. They provide good yield, so you can shift your assets there. And last but not least, utilities always do well in recession because utilities is that sector that people forget about when the economy is doing great, and they rush to when the economy is doing bad because your Pepco, your Dominion Power, your water, like that's money that's always going to come in. We always have to pay our electric bill. We always have to pay our water bill. So that money is never going to run out, never going to stop. And they pay a good dividend yield. So that's the sector to be in. So that's number one. shift your stock portfolio to less riskier stocks and get defensive. Okay, that's how you protect your wealth and actually grow your wealth. Number two, you want to start to own real assets. Okay, safe haven plays like gold and silver are really good plays. This is 100-ounce silver bar. Okay, and if you've been studying the gold and silver market the last few months, you've seen a big run up in both of those commodities. Okay, and they're going to continue to run up while we go through a recession for multitude of reasons. Okay, safe haven, it's a hedge, all that, and then gold and silver has always been money in the economies prior to the U.S., and it's always going to be money. So it's good to have that in your portfolio regardless. And lastly, still sticking with the hard assets theme, you want to own asset producing assets that produce cash flow, because cash flow will weather the storm in a recession or when the economy, depression or whatever, when the economy really tanks. Okay, think about it this way: you have a savings account. Okay, say you have $100,000 in your savings account. You lose your job. Okay, your main source of income is gone. Matter of fact, that's your only source of income. It's out of there. But you say, you know what? I got this savings. I got this $100,000 in the bank, so I'm gonna be good. And you're right. You would be good for a few months. You would be a-okay until you can find a new job and then you can replenish your savings. But let's say it takes you 2, 3, 4 years to find another job. How long will that $100,000? Eventually, you're going to run out, regardless. Time, if you allow time to creep in before more income comes in, that $100,000 is going. It's going quickly, okay? Because you got all kind of bills that you got to pay, and it's just going to run out. If you're not replenishing it, it runs out, okay? It's just logic. It's just going to run out. So you got to have cash flow to replace the savings, and the cash flow is going to weather the storm. Yeah, we might go through a recession. Who knows how long it's going to last? Who knows if your job is going to be secure? You might be cool today, but tomorrow you're let go because your company was like, well, I thought the recession was only going to last a year. It looks like we're going to be in this for a while. I got to let you go. You're a great worker, but I got to let you go. So you want to make sure you have cash flow, and from assets that produce cash flow, mainly real estate, in your portfolio. So that's three ways to protect yourself in this next downturn. Switch your stock portfolio from aggressive technology stocks with high multiples to more defensive companies that also pay a good dividend yield. Okay, utilities and defense sectors and in Walmart. That's it. Those are good examples. 2, you want to get you some gold and silver because these things are going to outperform. Okay, they're going to outperform when the stock and other asset classes start to tank. These two characters and other commodities, oil or they'll outperform. Okay, and then lastly, you want assets that are going to throw off cash, because see, gold and silver doesn't throw off cash. Okay, in fact, really they don't go up in value. To be 100% honest with you, the only reason why you might see silver trading at $15 a day and then tomorrow trading at $16 just means that it's taking more dollars to buy that same asset. Okay, that's not a reflection on the gold or the silver. It's more of a reflection on how strong or weak the U.S. dollar is. If inflation creeps in and it takes more dollars to buy that same ounce of gold or silver, that doesn't mean gold and silver went up in value. That just means I got to spend more. I got to work harder, spend more dollars to get the same asset. So, so they don't throw off cash is my point. So they're good to have, but you also want assets that do throw off cash and mainly monthly cash to help you weather that storm. So I know this video was a little longer today, but please, 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 I want you to, well, if you stay with me this far, obviously you watched the whole video, but this is really critical information. It's going to help you, okay, weather that storm, because again, no one knows how long the recession is going to last and how severe the recession is going to last. When you have all this extra debt in the economy, you never know, right? And I know people, you'll read from some economists that'll say, well, as long as the debt is denominated in the currency of the country that produces the debt, then they can inflate the debt away. That could be true, but the confidence of that currency will wane, and when it wanes, you can't get it back. Once people think, okay, that dollar is not gonna be worth anything, you're not gonna get that confidence back. They're definitely gonna run to gold and silver. You see what I'm saying? So it's critical that we prepare ourselves, because we don't know how long this recession will last. In fact, it might not be a recession. The Fed is lowering rates as we speak, so they're trying their best to keep this economy propped up. But when it does turn, how long will it last? How severe would it be? Prepare yourselves now and get ready. And if you have questions, give us a call. Send us an email. Reach out to us on Facebook or whatever other social media platform, YouTube, that we use, and start getting your ducks in a row. Okay, you want to be prepared, and it's just smart. It's just good business to be prepared and know how to weather the storm. So, New Level Investment Management LLC and New Level Realty LLC. Thanks.